Nitrogen fund is a low volatility equity hedge fund managed on a fundamental basis with a value bias. The fund has 245 million rand of assets under management. Rowan Williams, director at Nitrogen Fund Managers, joins us in studio for more. Right now, the state of the world. Let's start with a big high-level question. How are you feeling, Rowan?
It's an interesting question. You've got a situation where I think clearly weak global demand, weak global economies. But as I was hearing just now, you've got a underlying support to equity and capital markets through very low interest rates, and which market pundits are calling the Bernanke or now the Draghi put. So that remains very supportive. So it's an environment where you have to be quite cautious, I think, in terms of outlook, growth outlook, economic outlook, but at the same time quite a conducive environment to actually investing. So it leaves us moderately bullish, I'd say, for equities and investing, but definitely you have to be quite specific on the sectors that you are looking at and investing in.
Ron, when you look at, just to lead on from that question, when you look at what's going to happen into the future, I mean, certainly in my view, the problems we sit today was because of the Greenspan put. In other words, when the dot-com bubble burst, all of that liquidity released into the market and the low interest rates led to this credit bubble, housing market, hedge funds. We all know the whole story. Now this bubble, that bubble burst. Now there's more excess money being put into the system. And at the moment, it's not doing too much, It's sitting there, inflation's low.
Yeah.
But what's the price? There's no such thing as a free lunch. What's the ultimate price of a few $1 trillion being thrown at the problem?
So there are a few impacts, and it was interesting. I was looking at the Jackson Hole speech last week. So, and actually what Bernanke started with was saying, what are the risks to QE3 in this continued environment of low or free money, essentially? And the first one actually was potential distortions of capital markets.
Yes.
And I think that actually it's a longer term cost, because you're seeing an environment where it's difficult to actually predict asset prices reasonably.
So is that bonds and hard assets, commodities?
That's right, and capital markets, bonds, which have I think run much harder than people have anticipated and are at very low prices, but still with disparities in that. And so I think that is one of the costs, and so the sort of the workings of the capital markets, but clearly they devaluing their currencies, so the US and the euro, and to some extent, and you've seen it, sort of currency wars and a race to the bottom. No one wants a strong currency. Look at the Swiss. They've been trying to devalue their currency. So, and that actually has a benefit on South Africa. We don't have a policy of printing money or aggressively devaluing the currency. You may argue the Reserve Bank does factor it in. But so that has a benefit to South Africa and also our capital market. So what may cost developing markets may be a benefit to South African markets. So that's all the kind of things that we think about and look at in South Africa, and South Africa as an investment destination in the context of the global capital markets, I guess.
In South Africa, does nitrogen have a sectoral bias at the moment? Is there a sector that's clearly leading the way?
So we favour sectors over others, and I think we've said it before. We still favour domestic financial and industrial stocks over global resource stocks. So, and as I've just said, global resource stocks are exposed to the global economy, and clearly
so the value
demand
argument doesn't stand strong.
No, and this is interesting. I think given the freer, easier monetary environment, sort of underlying exact valuations are playing less of a role in this current market. I'm not saying, and we are value investors, so that is the basis on which we invest. But you have to factor into these current factors in terms of how they're impacting valuations. So we feel that people are looking more at the underlying demand as opposed to the fundamentals of valuation, and it's actually making it quite difficult to value. And that's what I was talking about, the risks in the capital markets. You could argue that sort of valuations are drifting at the moment maybe further from fair value than they would in a more normal capital market environment.
So it comes back to your earlier point. I know you're going to jump in here, but heed caution.
Yes. Yeah. So, but the interesting thing, caution, and especially a hedge fund also, we may be a bit more unique where we have to have a trading mentality. We have to think about not only what's going to happen in 3 years, 5 years, but in 3 weeks, 5 weeks, or maybe even shorter. I don't want to say we're too short term. But you have to take advantage of current market conditions to generate returns, whilst having your eye also looking a bit further out on the horizon as well.
Rowan, just 2 questions from my side. The first one's leading on. Resource shares are 8, 9 PEs, SABs and ShopRites are 20, 28 PEs. Surely the scenario that you've sketched is already in the price, and even more so. I'm just scared that in 3 years' time, people are going to look back and say, didn't you see that this was just a sitter? I mean, the valuation disparity has never, ever been this wide. Simplistically, if you look at Anglo-American and SA breweries, valuation disparity has never been this wide, ever, and these companies have been listed for decades.
Right.
So that's the first question. The second one is, your fund has got 2 components. Explain the 2 of them. Explain the difference between the 2 components of your fund.
Okay, because the second question kind of leads from the first as well. So basically, there is a massive valuation disparity, and a lot of investing is about your time horizon. So if you have a longer term time horizon, I would say the argument in terms of the valuation disparity is a good one, and there are opportunities, and you need to be considering those. So probably for very large funds, and you've heard from a lot of big fund managers saying they are now favouring resources over those overpriced or highly valued industrial stocks, you need to start looking at it. But I think there'll be a catalyst. So part of investing also is about, and especially value investing, is looking for a catalyst. So what is going to unlock this value disparity? There's a value disparity, as you say, on a historic basis. And it's going to be an increase in demand, or at least, I think, confidence around prospects of increasing demand in the broader global economy, the large developed economy. So if we see coming out of Europe, say, a sustained answer to the current debt crisis in terms of Euro bonds, or Germany being a lot more positive about supporting the other economies and the bond markets of those other economies, I think then in terms of the market sentiment towards sustained economic growth will change. And so, okay, maybe you didn't get it at the bottom, but we would rather be in a position where we see a clear way out of the current situation before going into resources and switching, say, then out of. So it's kind of a switch of the current environment, essentially. And if you want my view, and that's why I'm not in resources now, is because I don't see that materializing in the next 6 to 9 months. Okay. But it possibly is getting clearer.
Let's drill down into the financials. Later on tonight's programming, we're going to be chatting about the micro lenders, the likes of a Capitec and Able, etc., etc. Where do you lie in terms of that second tier versus the first tier, the big banks?
Yeah, so we are very skeptical of micro lending and the massive growth in the unsecured loan books. We think it's very difficult to have a model, and I mean we saw it with subprime, and there was an article today around this is not that different from subprime in terms of this massive expansion of lending. It's difficult to predict whether people will repay these loans. And you're also basing the model on the current economic environment. And obviously
where interest rates are at record lows, money is cheap, etc., etc.
And even though there may be a short-term bias to maybe rates going down a little bit further, they are at record lows, and they must go up. They must go up. And basically commentators are saying if rates go up globally, they're going to start going up locally as well. And that
leaves our consumer exposed.
Exactly, very exposed. And you've got, and what's most concerning is the way they've been growing these loan books. Not only that they've been increasing the amounts of the number of loans, but the term is longer and the capital amount is higher. And so obviously you've got a much longer risk.
Much bigger.
And they could be a good payer for 6, 9, 12 months, 15 months.
But then we have successive interest rate hikes, and suddenly the squeeze comes.
Right.
And
normally you only get squeezed when rates go up. In other words, low rates hide multitude of problems.
But when the rates start going
Oh,
up,
yeah.
when it's going to happen quickly, the
Yeah, but
cycles turn.
But we've spoken about this so often, yeah.
The anecdotal evidence coming out of Abel and some of the credit
Yeah, exactly the
retailers
same.
is that they're already seeing some pressure. And that's coming more from not increasing interest rates, but rising cost of living in the form of petrol prices and some food inflation. And that's what's been putting pressure already on the ability to service the loan.
Switching to industrials, your top plays in the industrial space at the moment?
So interesting, we have a large book of retailers, although we hedged. So we're playing them because there's a lot of activity, a lot of disparity, I think, on views on valuation. So there's a lot of opportunity to play those disparities. We still like some of the interest rates sensitive stocks. So we've recently built a reasonable position in CMH, which is a very focused motor
Combined
dealership.
motor holdings.
That's right, yeah. Where there's still good growth in new car sales, and that will feed through into that kind of business. So yeah, that's still where we're playing the interest rate sensitive type of sector, more consumer driven. I'd say that's
and
our
capitalising on the consumer story. Do you look at the component beyond South African borders, saying how are these companies capitalising on the Africa consumer story, or is that not important?
No,
at this
that is
point?
important. It's important because it has become a big input into foreigners' views of the valuations of the retailers. So we may have a different view, and I think we do have a slightly different view to them. But I think it is something that we look at, and can these companies access African growth from South Africa, and yeah, it is an input into our process.
Rowan, thanks so much for your time. As always, Rowan Williams, Director at Nitrogen Fund Managers.